53 AI startups have burned through over $100 million in venture capital each, and not a single one is profitable. We're not talking about small losses or temporary setbacks. We're talking about companies with nine-figure funding rounds that are torching cash at a rate that would make previous tech bubbles look conservative. And here's what most people don't understand. This isn't sustainable. And when these companies run out of runway, and they will, it's going to reshape the entire AI labor market in ways we're not prepared for. I'm tracking exactly which AI startups are running out of time, what their collapse means for job displacement, and where the real opportunities emerge when the dust settles. The scale of the problem. Let's get the numbers straight because they're shocking. According to startup tracking data from 2023 and 2024, AI companies are burning capital at rates we haven't seen since the dot-com era. But here's the difference. Back then, companies at least had theories about user growth and market expansion. These AI startups? Many have no clear path to revenue whatsoever. We're seeing AI research companies whose entire value proposition is we're building cooler models, raising $200, $300, $500 million rounds. They're hiring world-class researchers at $500K plus salaries. They're paying cloud compute bills that would bankrupt traditional software companies. And they're doing this with zero revenue. I'm not exaggerating. Check the SEC filings. Look at the burn rates. Some of these companies are spending $10 to $15 million per month on operations, and their total revenue is literally zero. That's not a sustainable business model. That's a cash depletion timeline. Sectioned right up. Here's what changed in late 2023 and throughout 2024. Venture capitalists realized something terrifying. The AI market isn't infinite. The competitive advantages of AI models are collapsing faster than anyone predicted. Open source models like Llama are catching up to proprietary systems. Everyone has access to the same GPUs. The moat is disappearing. Meanwhile, the three companies that actually make money in AI, OpenAI, Anthropic, and Google, are capturing almost all the value. Everyone else is fighting over scraps. So the VC money that was flowing like a fire hose in 2023 got turned off. Not completely, but selectively. Only companies with clear paths to profitability, defensible advantages, or massive existing user bases are still getting funded, which means dozens of AI startups that were expecting Series C and D rounds aren't getting them. Think about the math. If you raised $50 million in Series B in 2022 or 2023, and you're burning $8 million per month, and nobody's giving you more money, you have 6 months of runway, maybe 7 if you're disciplined. That's where we are right now. We're in the runway countdown phase. Which startups are in danger? This is where it gets specific. The highest risk category, AI research companies with no product. These are the companies founded by PhD researchers who raised huge rounds because their papers were impressive. But papers don't create revenue. They create intellectual property. Second highest risk, B2B AI companies solving niche problems with expensive sales cycles. An AI startup that's trying to sell to enterprise clients might close one $500K deal every 6 months. Meanwhile, they're burning $3 million monthly. The unit economics don't work. Third, AI consumer apps that blew up on launch but couldn't monetize. They had millions of users, but generated pennies in revenue. Once the novelty wore off, user retention dropped, and they never found a sustainable pricing model. Fourth, companies caught in the feature versus company trap. A startup builds a really good AI feature, but then Google or Microsoft or OpenAI copies it and bundles it for free into their platform. Suddenly, the startup has no moat. I can't name them all without legal consequences, but if you've been following AI news, you know the names. The companies that got massive press coverage in 2022 and 2023. The ones that made predictions about replacing entire industries. The ones that raised on hype rather than traction. Most of them are in trouble. Here's what happens when these startups start collapsing. First, they'll try to extend runway through layoffs. We'll see another 20 to 30% reduction in AI startup workforce. Talented engineers and researchers will flood the job market. This suppresses salaries in AI roles, which is actually interesting because it means AI development becomes cheaper for surviving companies. Second, they'll try to get acquired. This is crucial. When a startup runs out of money, acquirers can negotiate from a position of extreme strength. A company that raised at a $500 million valuation might get picked up for $50 million. That IP and those researchers get absorbed into larger companies. Third, and this is important, the intellectual property doesn't disappear. The models, the research, the techniques, they get consolidated into the companies that can actually afford to maintain them, which means we'll see acceleration in capabilities at the big three players. Fourth, the jobs don't come back. When an AI startup shuts down, those engineering positions are gone. The company that acquires them doesn't usually keep the same headcount. It's acquisition for talent and IP, not for team size. This is the cascade effect. It concentrates power, accelerates automation, and consolidates the industry around fewer players. Here's the part that directly affects the AI to jobs conversation. When you consolidate AI development into fewer companies, you actually accelerate job displacement because 1. Fewer companies competing means less competition for talent, which means they can be more selective. They keep the top 20% of researchers and engineers. Everyone else has to retrain or shift careers. 2. Consolidation reduces diversity of AI applications. When 10 startups are each building AI solutions for different industries, that's broad innovation across the economy. When 2 companies dominate, they focus on maximizing their own profit, usually meaning the easiest automation targets. 3. Big companies have incentive to push AI into production faster. Smaller startups moved cautiously because they needed customer trust. Google doesn't need trust. It has market power. It can deploy automation more aggressively. 4. Smaller companies were often specialized. They built AI for specific verticals with specific knowledge. Consolidation means standardized solutions that work fine but eliminate niche jobs and middle-skill positions. The irony: the AI startup collapse accelerates the very job displacement that the startups were supposedly going to manage slowly. Section 6. Where the opportunities are. Now, this isn't just a collapse story. There are actual opportunities here. First opportunity. The acquisition wave creates climbing room for mid-level technical talent. If you've been stuck in a role, this is the moment when companies are reorganizing and promoting internally. Second, companies that build tools for AI development become more valuable. If you're building infrastructure, not consumer AI, your customer base just consolidated, but they have more resources and more urgent needs. Third, the survivor AI companies will dominate for years. If you get in early at one of the 3 that survive, your upside is enormous. Fourth, industries that haven't automated yet become targets. Startups collapse, their technology gets absorbed, and then it gets deployed in healthcare, legal services, creative industries. New job displacement waves, but also new opportunities in managing that transition. Fifth, paradoxically, specialized AI consulting becomes more valuable. Companies know they need AI, but they're not sure how to implement it safely or effectively. Consultants who understand both the technology and the business risk will be in demand. The AI startup collapse isn't a story about failure. It's a story about consolidation, acceleration, and concentration of power. The companies that survive will be stronger and faster. The jobs that disappear will disappear more completely. The opportunities that emerge will favor people who understand both the technology and the business economics. This is the inflection point. The hype cycle is ending,